left, right.
Right now in 2022, there are two things that just don't adjust for inflation. You look at a gallon of milk, roughly the same when you account for inflation. You look at a vehicle, roughly the same when you account for inflation. You look at gasoline, roughly the same. Look at the price of a TV, it's actually come down quite a bit. Now, you want to talk about education and you want to talk about home loans. These things, home loans and the price of a home more specifically, and that is the topic of this episode. Today we are talking about the cost of buying a home and the surprising fact, and this really surprised me in the research, as to what is leading the cost of homes so astronomically high. And I promise you, has nothing to do with coronavirus right now, and it has a lot less to do with general interest in moving out of cities. So listen on, let me know what you think, and I will catch you guys on the flip side. This is SipTalk. Grab a drink and enjoy.
Of course, it's good.
Cheers.
Cheers.
Cheers. All right, we are live. This is Sip Talk, episode 182. My name is Justin DiGiulio, out of my basement in New Jersey, joined by James, the Bosnator Boswell, out of sunny South Carolina. James is a philosopher, a professional referee, a bartender, and most exciting of all, an accountant. James, how's it hanging down there in sunny South Carolina?
It's pretty wonderful right now. Late
see you
April, early May is beautiful. Like, we get some thunderstorms every once in a while. The weather's great. You want to be outside. Not as good as San Diego, though. But that's just because San Diego wins every day.
Well, yeah, that's different climate over there. But I noticed you got 4 or 5 buttons unbuttoned on your button up there. So you're really.
I think it's 3. One,
It's
2. 2.
it's a pretty low V you got there. So I assume.
I figure that they're tuning in for the cleavage. So
I assume it must be pretty nice and pretty nice weather. Pretty warm down there. Up here, it's still very cold. Today was an icy day. I got a chip in the windshield yesterday, and today the chip had spread to a nice crack all the way across the windshield. So that was a nice, pleasant surprise.
time to replace that.
Yeah, I guess so. Actually, it's a new windshield because there was one last year. But either way, we got to get into the topic. We got to dive right in. Say hello to Lisa on the live, and anybody else who is listening to us live. You can tune in by clicking the link in my Instagram profile while we're live on YouTube, Facebook, Twitch, Twitter, TikTok, Instagram. Don't forget to subscribe on YouTube and the audio podcast platforms. Today, we are talking about, James, this is really your topic. I've titled it "The Housing Bubble is About to Blow," but I'm curious your angle on this one.
Well, I think that's accurate, but it's kind of from the opposite direction of the last time the housing bubble burst. This is one where, like, I work in mortgages, so I see it every day, but seeing tons of news articles about how unaffordable housing is, what prompted this one was somewhere in Canada, I think around like Vancouver, that builders are complaining that they're having a hard time being able to meet the demand for new construction because the workers that build the houses can't afford to live there to build the houses.
Wow, that is interesting. Yeah,
because like most construction jobs, like you're going to live in the city in which you're building things. Like, it's not like travel nurses where they just kind of like go around the country for different gigs. You're a construction worker. You live in a city and you build things in that city. So nobody that does construction work can afford to live in Vancouver, so they can't build no homes because
they can't build no homes.
New homes.
Oh, okay. Yeah, but this is a pretty complex topic because there are so many moving parts when we talk about inflation, when we talk about housing costs. Should we lead with the kind of inflation and the data we have on that first? Because I like what you put together, little chart
I don't want to talk about that at first. Like that
Okay.
that's kind of reference numbers to bounce back around on. Especially when you look at things like the cost of gas and the cost of milk. And like you can look at some consumables that stay pretty flat when you adjust for inflation, and you can see some that go up and some that go down. So when you look at like housing's probably the most important thing because any other costs you don't even really have a chance to spend money on those things because you don't have a place to live. Like that's probably the most basic human need is
Well, yeah,
housing.
and it takes up the majority of the income.
I mean, I guess food would be the most basic human need, but because you're not going to die if you don't have housing, but you're definitely going to die if you don't have food.
Sure, but housing takes up a greater amount of your budget, and shelter is a secondary to food. But you kind of need both to have an existence.
Yeah. And also been hearing my brother in San Diego complain about his inability to afford housing, and he's making almost $100,000 a year, and there's like nothing he can afford to buy out there. He lives in a condo building right now where he's renting out an individual unit, and he's spending probably about 24 or 2,500 a month in rent, and he's splitting that with a roommate. And do you know what the units are going for? Because some like every once in a while, one of them will sell.
Yeah.
Do you know how much they're going for? Just
Um,
take a guess.
so he's spending the rent on his is 2,500. So
Mm-hmm.
we can assume that 2,500 covers the mortgage on that property. Obviously, the person didn't get the mortgage just now, and my guess is probably somewhere over the last decade this person has a mortgage. That's just a general guess with no information. But I'm going to guess that $2,500 is going to cover maybe a $450,000 mortgage. We could look. I'm just throwing numbers out there, but I'm going to guess that that would be a million. It's a two bedroom. I mean,
His is yeah, 2 bed, 2 bath.
two
It's
bed.
a it's about the same size as our apartment was when we lived together in Charleston, and it's about 3 blocks from the beach in Ocean Beach, San Diego.
Yeah, I mean, I can't imagine a two bedroom condo in San Diego, super close to the beach, being less than $1 million. But that's I don't know the economy over there. That's so I'm super
So
curious the
I
the
think a
reality.
unit 2 doors down from him sold for about 790
Wow.
about
Okay.
a week ago. So you're not too far off. And on $100,000, that like I don't see how you can afford an $800,000 condo.
No. What's what would a mortgage? You should know this pretty quickly. A mortgage be on 800,000, like
Well,
30.
when I ran the numbers for a $650,000 condo, um, with mortgage plus property taxes and the HOA fees because it's a condo,
Yeah.
he was looking at about 4,500 a month.
Hmm. Which is almost double what his current rent is.
Yeah.
Yeah. So
Yeah,
that's
he's doing very well in terms of his rent compared to the area, but
yeah. But just still, the fact that he's paying off somebody else's mortgage, and
they
they
might
have the
not have a
condo to
mortgage
rent.
anymore. Apparently,
What?
it was an old person that lived there that died, and so I think the family inherited it, and they're just renting it out because they don't have a use for it.
Oh, okay. So maybe more. I don't know how long ago. What are you drinking down there, by the way?
I got my last Bush Ice. Next time I go to the grocery store, I might even change it up.
Oh, what are you thinking you may change it to?
Well, it's hard to go with anything cheaper, so I might have to go more expensive.
Yeah. And what did you have in mind?
I don't know. Something summery, maybe like Paulaner or Francis Connor.
I'm not familiar with either one of those.
Hefeweizens, the
Yeah.
unfiltered wheat beers.
Mm,
A
all
good
right.
one will have like a real like taste and smell of like fresh bread.
I love my bready beer. Uh, all right. So let's get into it. So you got your brother in San Diego. He's paying roughly what half of a current mortgage would be. He's making good money, but he couldn't afford to buy the place
Yeah,
that he's in.
and like to get like a house in Ocean Beach, you're looking at like probably 1.2 million to, well, considerably more than that.
So typically the way that it works is that people's rent are going to be similar to what a mortgage monthly cost is, just a little, the rent will be a little bit higher than what a mortgage would be. The difference is that, you're renting because you don't have that down payment saved. So traditionally, you're trying to save a down payment, but you're paying a little bit of a higher rate than the existing mortgages because that's just how it goes. They got
Yeah.
there before
Well,
you. They got a
and
mortgage on the
rent will be
place before
slightly
you.
higher than your mortgage, but when you're paying the mortgage, that's not all of your housing costs because you're responsible for the property taxes. You're responsible for the repairs.
Well, yeah. So if I, and just, kind of for easy numbers here, I buy a $100,000 single family house and, my monthly costs are, say, $1,200 with taxes, everything included. So I'm going to rent it for $1,400 or $1,500. So the person there is paying more than what I'm paying, but I got there first.
Well,
So
it's also you're the one who's responsible for the repairs and upkeep of the place, and you have to factor that in above the normal cost of servicing the mortgage and stuff.
sure, but if that person wants to buy property, they're going to get in after me, right? So they're going to end up paying a little bit higher anyways, and they have to take the time to save that down payment. Now, it shouldn't be that, and so your brother's in a unique situation that he's not paying over what the current mortgages in the area are going for. So
No, not even close.
presumably somebody in a comparable apartment to his renting a comparable condo to what he's in right now, if they're selling for 850,000, they would be paying 4,500 bucks. So your
Yeah,
brother's got a good deal. He's not indicative of the rest of the
no,
market.
he's lucky then because
He-
so I want to get into some of the causes of this problem because um, like you hear this all the time, and we were talking about this earlier today that people in our generation and the generation just one younger than ours feel like they might be in a position where they're perpetually renting, where they don't expect to be able to buy a home at all because they're not affordable.
well, let's look at, let's just on that. Sorry to stop you, but let's look at what a down payment's going to look like on an $850,000 condo.
Well, I think that you can't. I don't want to talk about the San Diego real estate market because it's one of the most expensive in the country. I think it's better to talk about a more average real estate market. And like, so if you look at the spreadsheet that I sent you and you look at like what's the median price of a home right now, so I'm seeing 428,000. So let's use that number instead because that's going to be more realistic for people.
Okay, and that's a bit higher than what we've been trending, but that is what it is right now. So
Yeah. Well, so it depends. Traditionally, people would say like do a 10% or a 20% down payment, and I don't think that that's actually good advice. And there are like so when I got my house, I did 5%. I could have done as low as 3. I chose 5 because I wanted to have a little bit lower of a starting mortgage, but I could have done 3%. There's some government programs. FHA allows you to do a home with no down payment.
yeah, that's very wild. But
So I would say let's go with 3%, which is the kind of the standard bottom amount that you can do. So 3% on 428,000 is going to be about 13,000 bucks.
I think we need to be doing something that's a little bit higher than that.
Well, let's do 5%. So
I think
428,000 times
I think
5%.
5% is a reasonable. Yes.
So that's 21,400 that
Okay.
you're going to be dropping, and that's not including the closing costs,
Yeah, attorney fees.
the financing
yeah.
fee that you're going to have to pay for getting the loan. You're probably looking at another 6 or 7,000 at least in closing costs. So you're looking at about $30,000 out of pocket, just to get just to get in the door. And Jeff and May says in my area in the past few years, I've seen many new investors getting into the game. They've been overpaying, which is why the rents are increasing so drastically. They need that higher rate. If not, they'll lose the property, and this is contributing to the bubble. I want to get to that in a minute.
That's exactly where we are going with this conversation. But James,
Yes.
sorry, I interrupted you to just throw some numbers out there. I'll let you continue. I got a lot to say, so I'm
Yeah, well, so Jeff is onto something, and that's that's very much where we're headed. We're just not there yet. But
Okay.
great comment.
Go ahead.
So yeah, like $30,000 on $430,000 purchase is completely reasonable, and for
What's a
some people, that's tough to be able to save up
well?
$30,000.
Let's look at what a mortgage payment for that would look like.
Give me a minute, I'll run the
Okay.
numbers.
Because my guess is if you were, I want to put it into context about what somebody who would be looking at a $400,000 home with 5% down, what their rent would be looking at as an alternative. So
So
what's a monthly
using the
payment?
average interest rate that things are going for today, which is about 5.5%, 430,000, 30-year loan, 2441.
So you're paying $2,400 a month for your mortgage
That's before
before property tax. So let's call it 2,800 on the low end. Now to rent that home, that would be $3,000 at the bare minimum.
easily.
So you have two. If you want this home, you have two options. You pay $3,000 in rent, or you pay $2,800 a month in a mortgage with $30,000 down. So you
Actually,
have to.
I want to revise that rent figure, and I want to hit on like so. I sent you the article from Slate about firms like BlackRock buying large amounts of residential properties. I want to get back to some of the other points in that article, but one thing that came out of that article from their financial disclosures is they had about $16 billion worth of assets and about $2 billion worth of rental income for the same period, which tells you that very basic numbers. They're pricing their rents on their property to be able to pay back in about 8 years.
Okay.
So if you take the purchase price of the property, divide that by 8, that's the annual rent. Divide that by 12, that's the monthly rent. So if you take 430,000, divide it by 8, divide that by 12, I get 4480 as your
So
rent.
they'd be charging 4,480 for that.
And so part of the problem is, um, like the article talks about how traditionally the payback period, if you look at the property value to the rent, the ratios used to be like 15 or 20 to 1. That would be considered like a good deal for the borrower or the renter. And so you've got these firms that are buying up these properties, and we'll get into like how that pushes out like usual buyers, but not only are they pushing out these buyers, but they're also pricing the rents really, really high.
Okay, but and yeah, and the issue is that the rent prices are high, and because you have more buyers in the game, the sales prices are higher. I just
Hmm.
want to go back to fully contextualizing this this $420,000 home with $30,000 down and a what do we say $28,000 to $3,000 monthly payment if you have a
Yeah, let me
mortgage on it.
take. If we do the down payment of 5%, then it's going to be a $408,000 loan. You're looking at 2317 before insurance and
So
taxes.
so let's call it $2,800 a month if you purchase a property.
Fine.
Okay. What's a salary have to be for someone who is earning what does somebody have to be earning to afford a $2,800 a month payment?
Um,
My guess is
Traditional
about 90,000,
78.
78,000.
That's at 40% debt, 43% debt to income, which is kind of like a gold standard in the industry. Is that you don't want to be at higher than 43% DTI.
Okay.
So to afford that house, and that means that 43% of your money every single month is going towards servicing the mortgage.
I was thinking it was 30%. I that's the first time I heard 43. So,
If you want to do 30%, then you need to be making 112,000
okay. All right. Interesting.
on your own.
All right. So what we have, so that's kind of, let's back up to the person that's earning 100 and what was it?
12.
112,000. They're buying a $430 house with roughly $30,000 down. Now, what's happening, and their rental alternatives are
Well, for I using the figures that BlackRock is charging, that $430,000 house would be charging rent of about 4,400.
so the problem is also that you can't buy a house for 28,000 right now because there is a better offer ahead of yours that's likely all cash and fast close by a company like BlackRock. So you're kind of forced into this rental pool. So you really have to be way ahead of the game with, being the first offer in and being ready to close as soon as possible to even be able to compete.
I'll give you an example. We had a loan cancel on us earlier this week, and the reason was it was a purchase. It was a $520,000 purchase, 400 and something $1,000 loan. So they're doing like 20% down, 500 and something $1,000 cost.
Which is a solid buyer.
Yeah, exactly. And the appraisal came in, and the appraisal said that the house needed about $200,000 worth of repairs.
Holy shit. Yeah. So what did the bank say?
So the buyer wanted to renegotiate, which makes complete sense. And the seller said no. So the deal fell through because the buyer didn't want to buy a house with $200,000 worth of repairs on it, because that's not what their offer was. Their offer was for a house that needed $0 in repairs. So they were gonna, like, I'm sure that they could have settled on something in between, but the seller said no. The
And
seller still thinks that they can probably get the full asking price even with the $200,000 of repairs.
yeah, and those repairs are less costly for a giant corporation who's going to come in, has the workers on staff, has the construction contracts out. That's not going to be paying the full price because they're able to buy
Yeah,
parts in bulk.
but that's what you're up against in this right now, is that even if you get a deal or whatever, like if it falls through, people are just like, yeah, I don't need to lower my price. I'll just wait a little longer.
So what I want to get into is and this is we have some interesting data that we want to share with you, and we want to discuss the facts, the different aspects in the economy that are driving up the housing cost. What we are leaning to, I believe James and I are on the same page as this, we're leaning towards one of the biggest factors being your corporate investors, your big companies that are coming in and taking massive amounts of the housing stock, paying all cash.
So one important thing about that is the type of housing stock that they're buying.
Yeah, let me guess on this, because I didn't even finish reading the full article that we discussed, but I want to throw a guess out there, and you can correct me. But here's what I'm thinking: typically, investors would want multifamilies, and they would want apartment complexes. I have a feeling the issue is that these investment companies, corporations, are coming in buying single family homes.
Yes, what type of single family homes? If you think about, like, because you can have a single family home that is like an 8,000 square foot mansion, or you could have a single family home that's a like single wide trailer in a trailer park. So give me like a market segment that you think they're focusing on for buying these single family homes.
Interesting. Well, it would have the biggest impact on average housing prices, I think, if they were buying the ones in greatest demand. And I would imagine that would be what we would call entry level homes. Am I accurate on that?
Yeah, it's going to be like the low to mid range homes that people tend to buy as their first home while they're still getting themselves established, both in terms of professional and income, like professional career and income wise.
So people in
So
their mid to late 20s or early 30s.
yeah, and it's not going to be like a giant home like the McMansions or like the brand new luxury buildings or whatever. That's
Well,
not what firms like BlackRock are buying.
my
They're buying the
research,
homes that were like built in the 60s, 70s, and 80s that were decently built, decently maintained, and still relatively affordable in not the super expensive neighborhoods and not the crappiest neighborhoods, but the low-ish to mid
the
neighborhoods.
evisceration of the middle class.
Yeah, and that's where they're buying their homes. So the people who need the homes the most are competing against a private capital firm with $1
There's,
trillion in assets.
there's no
Literally $1
competition.
trillion in assets.
So I actually learned today that entry level home is defined as under 1,400 square feet. And actually, there are 80% less entry level homes being built now than there were in the 1970s and before then. So the number of entry level homes being built are considerably
Well, part
fewer
of
than
that
ever
is
before.
for the builders. it's less profitable for them to be building homes like that.
Well, yeah, you're making less profit per home sold.
Yeah, so why, if you're a builder, why would you take offers for anything other than like the luxury stuff? Since right now there's such a backlog in demand and builders are slammed. So if you have as much work as you could possibly want and then some, why would you not be taking the most expensive contracts out there?
Yeah, I mean, if your business is jam packed already, yeah, it doesn't make sense to take other small jobs. You take only the big ones. Which, let's see, I wanted to share about the cost of creating homes and the increase in that. So we know that cost of goods is going up, cost of labor has gone up, cost of fuel has gone up, cost of general supplies, building supplies, hammers, nails, working
Wood.
supplies, and then also grossly the cost of wood has gone up. The National Association of Home Builders says that lumber increase, the increase in the price of lumber has had an average increase in the price of homes of $18,600. That's just the cost of lumber, adding to the cost of the final sale price. But the cost to create new homes and the cost of construction has skyrocketed, and that really affects. You're not going to let that eat into your cost of building a $100,000 house.
No, you're going to tack that onto the bar.
You're going to, yeah, but you're also going to be building a house that's now 400 or 600 or 800 or a million,
Yeah.
because you get more payback for the buck there.
So I think I want to talk a little bit about potential solutions here.
Hey,
Or are we too early for
We're
that?
way too early for that. I feel like, because I really want to dig into the problem, and I do want to hit the data that we have about the prices over the last 30 or 40 years, but also I really spent some time trying to figure out why we have such a housing shortage, and it's odd because the population in the United States is not increasing at that vast of a rate,
In
and
terms of,
people.
well, you can look at like population growth and compare that to housing price growth. And like in the past 10 years,
But you have a certain number of people who live in a certain number of homes. If the number of people doesn't change, how do we need more homes?
well, that's what I'm getting to is I think in
Okay.
the last 10 years, we've probably seen about 20 million people. So 330 to about 350, right?
I didn't know we were that high, but
I don't know.
I thought we were still in that 330 to 340 range.
Um,
You could ask Alexa. Except you're not an Alexa user, so
no, I don't trust it.
what
Okay,
do you-
330 million we'll go with in 2020. So
Okay.
330. Population in the United States 2010 was 309. So
Okay. So
20
about
million people.
20,000 in a
So
decade.
yeah. So just between 2010 and 2020, looking at the inflation adjusted price of a house, we go from 294 to 365.
Wait, so, hold on. So the data that you're citing here is what the cost of a house was in when?
2010 to 2020.
And
294 to 365. So the population went from 310 to 330. The population went from 294 to 365.
yeah, so the huge increase in prices not correlating.
So it's not an increased population creating a shortage of housing because we all of a sudden have way more people than we had houses. It's the housing supply has remained the population has remained relatively steady compared to housing supply, but for some reason housing costs are just completely blowing up.
And Jeff says an issue is that the goods didn't go up at the rate due to manufacturing. It's simple greed. Well, I think I understand what he's getting at. The cost of housing has gone up. It doesn't fluctuate as much as the cost of other goods, but other prices will come down. So oil goes up, it'll come back down. Goods that are in demand now because there's a bottleneck in the pipeline, those good prices, I imagine, will also come back down, and that'll have an effect on the inflation rate. but I don't see the housing cost rate. The housing cost, I don't see that going down because
No.
because
The last time that we saw housing prices really correct downwards was because of the mortgage crisis 13 years ago. But that was an economic crisis, really like a one every 30 to 50 year event.
well,
And
but
it was also specifically targeted at the housing market.
but here was the issue with that bubble and how it burst. That bubble burst because you had people who were in homes that suddenly the value of the home decreased and they owed more on the home than it was worth, and they also couldn't afford to pay because there were many bad mortgages written. They couldn't afford to pay what the home was worth.
Well, you're getting the cause and the effect wrong. The cause was
Well,
people were qualifying for mortgages that they couldn't afford, and when they eventually couldn't afford to pay for those mortgages anymore, the bank would foreclose on the property, and it was a spiral of increasing supply. And at the same time, all these people that are getting kicked out of homes are having terrible FICOs because their credit's been ruined from having a home that they couldn't afford. So you have an explosion of supply at the same time that the demand is restricted by all these people that can't afford to buy a house.
yeah, kind of. I delivered it poorly, but it was self fulfilling, and the cause was that bad mortgages were written, and then people couldn't afford housing because bad mortgages were written, and then it basically became impossible for people to buy homes. Now we don't have so much bad mortgages being written. The mortgages now are much more sound than they were before, so it's less likely we're going to have a lot of defaults on the loans like we did before. The issue is that the cost of living in general is rising so much, and this also includes renters.
Yeah, well, when housing was really cheap in like 2010 and 2011, as all the supply was on the market and like most people were economically depressed and weren't able to afford, you know who bought all those homes?
No, bank.
Investors. The
Okay.
people that had the money. So like because if you're an investor and you've got a ton of cash, you can afford to take the risk on a property and say this might not pay off for 3 or 4 years and just sit on it. Like I don't have the ability to just like drop a whole bunch of money into something and say if this doesn't work out for 3 or 4 years I'll be okay. But if I had millions of dollars and but if I put half of that towards some houses and they don't pay off for a couple years, I've still got money in reserve. So because they have so much money, they can afford to run lean because their lean is a lot fatter than whatever my lean is. And
Yeah,
so they were able to buy at a good opportunity and
but
then
also yeah,
rent out the places and make the money or
but yeah,
sell
but
them back at a profit. But
the
the
corporations don't need to compete with the everyman because they have the money. One, they can afford more, but also if they need a mortgage, they're getting lower rates on on their own money basically because they're not borrowing with a conventional mortgage. And then also most of them are buying in cash anyways, and they're recouping with rental
Yeah.
dollars.
Well, so here's another point that private comment I got is that when all these people that are retiring, all these boomers are retiring and they're moving somewhere else, so they might have like a large house that they used when they were raising a family and now they don't need to live in such a large place. So instead of selling that house, what they're doing is they're renting it either on longer term rentals or they're just like or they're hiring a property manager and Airbnb-ing it. So supply is not being replenished by people dying off or moving.
Housing supply available for purchasing. Okay,
Yes.
yeah, that's a good comment. Can we uh, talk about these prices? Because I know you weren't crazy about this data being super relevant to the greater
The
point of
wage data I don't trust. I think I misinterpreted it. So don't
the.
use the wage data.
Okay, yeah, I think there might have been some. I talked about it in my office today,
No,
but
I think it's indexed. It's an index that they use, and I was interpreting it that as like a weekly cash wage, where it's actually an index of cash wages.
yeah. So okay,
So don't use the wage data.
Okay. Well, you have the. Uh, let's not talk about. I want to draw attention away from housing costs first, and then I want to draw it back to housing costs. So the price of fuel in we go back to 1995, $1.08 a gallon. Now, let's say 2020 data, because I don't want to draw crazy attention to 2022 just yet, because there's a lot of major factors that have happened that aren't quite. We have a big spike in 2022, but
The war in Russia being the major driver,
especially when it comes to gas, not to everything else on here. But
Yeah.
I'm gonna pull the 2020 data because it's the most stable for the point that we're making here. So 1995 cost per gallon of fuel, $1.08. 2020, $2.58. So $1.50 raise.
But that 1995, adjust that for inflation, and it's $2.04.
So we don't have a huge jump in gas prices. Milk back in 1995, $2.47 for a gallon.
Yeah.
Today, a gallon of milk, $3.92.
Yeah.
So
Adjust the 95 figure for inflation. What do you get?
$4.66 versus today's $3.92. So the cost of milk actually has decreased.
Mm-hmm.
So let's go back. Oh, you don't have this. I'm going to have to freeze the first two columns here, or at least column number one. Okay, so I'm going to freeze column number one. And let's hit the new vehicle price. So new vehicle 1990, 13,000. In today's dollars, roughly 30,000. New vehicle in 2020, 25,000. So it looks like the cost of the average new vehicle has gone down just a hair. We'll call that.
But if you look at the 22, like I included the 2022 figures because a lot has changed because all of my figures are referenced from January of that year. So January of 2020, very different than even June of 2020, let alone today.
Well, January 2020 was not in the pandemic.
No.
And you got average cost of a new car, 25,000. January 2022, this year, average cost of a new car, 47,000. So almost double the cost of a car. And I can tell you, I've been to the Audi dealership near me. These guys are telling me how much they're selling over sticker, how they can't keep cars in the lot. Just truly, truly wild. A lot of that supply chain.
A lot of that's also salesmanship.
Yeah, well, sure, fair enough. Yeah, these guys are. I mean, they're taking advantage of the market, and
They're telling you, yeah, these things are going over sticker, so that way you won't haggle with them.
Oh, I'm not buying any cars.
Yeah, but you know what I mean.
But yeah, that's also a great sales tactic, you know. But yeah, so the average cost of a vehicle actually hasn't really increased. It may have actually decreased if you're not counting the pandemic.
If you don't count the last 2 years, but I think you have to.
Last year and a half, we'll call it. Last year and a half.
Okay.
But I think if we were to look at this 10 years from now, this would be a blip and we'd be closer back to our original trend line.
It might be because like cars are a special case because one of the biggest supply chain constraints right now is with silicon and chips.
Yeah.
Because today's cars have so many stupid computers in them that the manufacturers might be able to build everything in the car except for all the crazy computers they have in them, but that torpedoes the whole car.
Yeah, you're not selling that car. But I would like you to draw so far that milk, fuel, cars, the prices really haven't risen that very much.
No, they're all pretty stable, really.
They're all pretty stable. Now I want to hit the TV numbers. So I looked back at the Sears catalog.
Can I make a prediction here?
Yeah, make the prediction. I'm curious.
My prediction is that the cost of a TV in inflation-adjusted dollars has gone way down.
Okay, well, you could throw the inflation on here if you want, but
Yeah,
you'll
give
just
me
have,
years,
add
and
column,
I've got the
column
calculator.
U. Add column U. I'll give you the numbers. So look at column U. Put in the actual number.
Yeah, hang on.
A brand new console TV in. Oh, let's do the 1985 actually. So 1985. I looked at the Sears catalog. Most expensive TV. $2,979.
2,900 in 1985.
1985. I need you to add one more column though, actually, for the cheapest TV,
Okay.
because I think the cheapest TV actually is a better indicator.
Okay. Go ahead.
Okay, so you got the cheapest TV in 1985 in the Sears catalog, $249. So the cheapest you could get a TV in 1985, $249. Now I checked, so I have 1980 data. I never input the 1990 data. Let's ignore it though. So I looked at the most expensive TV 2022, and it was 15 grand.
In 2022.
Yeah, it was a 98-inch Samsung Smart TV. So just wild. The By the way, the Sears TV back in 1985 were console TVs where the selling points were like the dovetailing of the drawer, like just
Yeah.
completely different. So you're talking
Okay.
about hold on. Now I want to give you the cheapest TV 2022. Cheapest TV 2022, $111. 13-inch TV, and the one I gave you from 1985 also 13-inch TV. So you got a $111 TV in 2020 for 13-inch in adjusted inflation dollars.
The 1985 $249 TV would be $665 today.
Yeah, so roughly a 600% decrease in television price. So the point is that some things are actually getting cheaper year after year. And that, which is some things, not everything.
Not only that, the 13-inch console, like it's gonna probably be an LCD screen or something. Like the 2022 cheap TV is going to be light years better than the 1985 TV.
This one was portable, by the way. It's a portable 13-inch TV. You just plug and play. Maybe it's got a battery pack on it.
Yeah. So, imagine, how much do you think that would cost? Like, never mind the fact that they couldn't manufacture something like that in 1985.
No, it would have been like a $55,000 piece of technology. Like, aliens delivered this. But look, now, so we're saying that inflation has kind of had an overall trend that isn't vastly higher or lower when it comes to fuel, milk, cars, electronics. Let's look at homes. So you have a 1980.
Let's just use the inflation-adjusted dollars because that's easier.
I think it's good to have both. Okay, just because I'll give you both. But a home in 1980, $63,000. In adjusted for inflation, this is what you should really be looking at it. $222,000. So that same home today, let's just skip. Nobody needs all this data. If you guys want to email us, we'll send you the whole spreadsheet. But
I think let's just. I want to race through it real quick. I'm going to give just the inflation-adjusted dollars in every 10 years.
Okay.
So 1980, 222, 1990, 272, 2000, 276.
Slow down. $272,000. You're just throwing numbers out there. Somebody's listening.
All right, so 1990, 272,000. 2000, $276,000. 2010, 294,000. 2020, 365. 2022, 429.
Which is almost double of what it would have cost.
Yeah, and this is using all inflation adjusted dollars. So this is not like money was just cheaper back then. No. You're spending almost double for a house today than you were 40 years ago.
Yeah, so a house 40 years ago was $63,000. Today it's $430,000. Now when you adjust the old number for inflation, you have $222,000. We're still 100% increase.
Yep.
Which none of the other things that we talked about trend up like that at all. Milk has trended
The only
down.
other thing that trends up like that would be college education and possibly healthcare.
So the college education one was one that I thought was a very important point to make when it comes to one of the barriers of entry to home ownership is that you have 22-year-olds leaving school owing 80 grand, 160 grand in debt. and you didn't have that 40 years ago or even
Nope.
20 years ago. So
No.
the barrier of entry on top of just the purchase price is somebody who's already saddled with an enormous debt already.
Yeah, you're already paying a mortgage and you don't have a house.
Yeah, very good point. Very good point. Let's see. I want to add some
Look,
more.
we got 15 minutes left. I think we need to move to what are some potential solutions here? How do we fix this problem? Because one of the questions that I've asked a number of people is I look at this situation, like when I saw that article today about how builders can't build homes because the people who build the homes can't afford to live in the area where they want to build homes. I'm thinking, this is not a sustainable situation.
So let's talk about sustainability. I want to give you another. So this Slate.com article you had about, was it BlackRock buying properties?
Yep.
And I think they said that corporate investors have bought 15% of the homes on the market in the first quarter of this year.
Right, but and like you also have to factor in that 15% is focused mostly in the areas of first-time home buyers targets.
So let's talk about unsustainability, because and this isn't from the article, but this is my take. Investment firms are buying the homes, and that's driving home prices up. But the argument for that would be, well, that's capitalism, and America is a capitalist society. And the way that I look at pure capitalism is like this. You ever played Monopoly before? Okay, everybody's played Monopoly before. Now you get 6 players. Monopoly could be a 6-player game, and I'm adding 6 players. You could go with fewer players, but
Typically, it's played with 4.
it'll only prove my point more so. So adding 6 players actually dissolves my point a little bit. But you get 6 players. They all start equal amount of money in the bank. They all start at the same place, equal odds. The greater amount of time that you play Monopoly, what happens?
Well, when the game is played properly by all players, eventually one player will have everything, and the other players will have nothing.
So as you play Monopoly, everyone goes broke. That's
Except
pure,
for one person.
except for one person. That's pure capitalism.
Do you know that's the reason that Monopoly was designed, was to, like, as an illustration of what can go wrong with capitalism?
I didn't know that was why, but that's what pure capitalism is, and that's when we're talking about solutions. That's where we are right now. It's a capitalist society. Let the investment companies buy the property. They should have every right to do so. And I was thinking about, like, how likely is a crash going to happen? But I'm thinking, if you have these investments being made by corporations typically make wiser and more sound financial decisions than most individual people.
Because
So,
they have the resources to be able to research things more, and they can also afford to
well, they're
kite
getting
risk.
they're getting better deals though.
Not necessarily. They
But
might be
they don't
paying
have.
more in the short term. They, like with them
They might
making
pay more on the surface for purchase price, but they're paying lower in interest,
Oh,
or
yeah.
they're buying all cash, and they can ride it out on smaller margins than anyone else can. So at the surface, they might pay more for the home, but they're gonna, even if they pay an extra 50 grand on top of the purchase price and pay in cash. What are you paying on what are you paying on a 30-year mortgage? Way more than 50 grand.
Yeah, and right now the average mortgage rates are 5.5%. Most of, like, any of these giant investment capital firms don't have a cost of capital anywhere near 5.5%.
Yeah. So they're not paying overall what you're paying overall. They may pay a
No.
higher upfront cost, but that's because they're winning on the back end.
But it's also like they can afford to kite risk. Where if I'm an investor and, like, I'm putting all of my money into, like, I've got enough money to afford one investment property, and I put all my money into that, and something goes wrong, I'm wiped out. But if I've got $1 billion, then one, my risk is spread out over multiple properties, and two, even if there's a general economic downturn, I can afford to wait it out for the other side of the cycle.
Yeah, and that's why it's unfair as it is. Two statements I want to make before we talk about solutions, and the second will be the segue into solutions. Another reason why we're not able to keep up with building homes, and this is something I missed a bit earlier, is that zoning and building permits are done on local levels, and the Fed adjusting interest rates is, they can't adjust zoning and building permits. It's not up to the federal government. So it's county by county, state by state getting together to issue these things. It can't come directly from the top.
Real quick, you want to hit Jeff's comment about individual investors turning to syndicates?
It seems that people who were individual investors are now turning to syndicates. This past year alone, I was asked to join 4 different syndications. So that's on the but yeah, I mean,
It's just there's even for people that want to be individual investors, there's heavy pressure from large corporate influences to either join them and like be part of their system or sell to them.
yeah, it's just that's also working against the initial home buyer.
Yep.
Which is really what we're talking about now. We're not so much talking about investors, so even though I do think that that's small investors are very important. I think the enemy here is the conglomerate corporations that are the giant investors.
All right. So
And
here, point two, and
here's
then
the statement.
solutions.
Here's the statement that came from the current administration, but was given anonymously to Politico. They said, we don't ask the question, can we solve the challenge entirely? It's, can we make a difference? Now, to me, that's the exact solution that is the worst solution that you could ever have when it comes to governing anything. That's your bubblegum and duct tape type solution. We're not going to look at a solution for the whole problem. We're just going to try to like change a couple of things and hopefully it'll slow down. But that's the same way that we treat our health crisis in the United States. We're not going to try to solve the health crisis from the cause. We're just going to kind of put some band-aids over the effect.
Right.
And
So
I think
it's two different approaches, and what you're getting at is the system itself broken and needs to be completely reworked, or is the system good and we just need to make some tweaks to the way that it functions? And I think when it comes to both healthcare and housing, right now the system itself is broken, and making small changes aren't going to work.
so what are we looking at then in terms of solutions for this housing crisis? How are we competing against giant conglomerate investment companies?
Number one, I think what you do is at the local level, property taxes. You have two rules. You have rent
Ooh, I like this
controls.
text. Okay.
So you have rent controls where based on the purchase price of a house, there's a maximum amount that you can charge in rent based on the most recent purchase price.
Wait, so you're restricting rent?
Yeah. So that way, because look, this is going to work in tandem with the other idea, which
Okay,
is
give me the other idea.
the other idea is, and most localities do this, but if a property is purely a rental, as in non-owner occupied, its property tax rate is significantly higher than if it were an owner occupied.
But that makes it that much more difficult for smaller investors. That makes it even that gives smaller investors a it makes it impossible for smaller investors and makes it still just as possible for giant conglomerate investors. So Jeff
So
is a smaller real estate investor. He's not going to be able to compete against BlackRock if the local taxes go up.
so here's what you can do then.
Because I think you need to
You can
have
make it so that the increased property tax hit only applies to entities that have an EIN. If you're an individual investor and the property is owned under your social security number, then you get a break on the property tax hit. But if it's owned by a corporation that has an EIN, they don't get that break.
But nobody would ever put rental property in their name exclusively because that would be a recipe to be fucking decimated by anybody who stubs their toe in the staircase. I think it needs to be based off of your total. It needs to be more of an income-based tax. And I'm not. Nobody wants to be increasing the taxes, but if you are
You're not increasing taxes on the people that are going to feel it.
I think it would need to be an income-based tax because that, to me, is the only thing that would seem to not destroy the everyman property investor.
Well, the problem is
who
that
has
most of
4
these
to 20
rentals,
units.
when it comes to income tax, most of these rentals are going to be generating a loss or a wash due to the way that depreciation works.
Okay, sure, but I don't know how much property Jeff owns, but I can tell you somebody who owns two families to 20 families versus somebody who owns 1,000 to 10,000 rental units are at vastly different income levels.
Yeah, but it's still each property is done individually. So if you're taking a single family residence, you're depreciating that over a 27.5 year period. So 127.5 of that property is a depreciation expense. So if your rent is a little bit more than the cost of the mortgage, you're going to be showing a loss for that rental, despite the fact that you actually made a profit because you're taking depreciation on that property.
So you can depreciate 100% over 27 years.
You have to. Not can. It's you must.
So effectively, the value of that home would be 0 after 27 years.
Right. So after 27.5
Interesting
years, if
catch,
you sell
yeah.
that house, I
Yeah.
buy the house for $200,000. In 27.5 years, I want to sell it. Every dollar that I make on that house is going to be profit. I'm not going to be able to deduct any of the cost of my purchase of that house against the sale because it was depreciated and expensed prior.
Would every person depreciate the value of the house, or would some
If it's a
maybe
rental
not?
property, then yes. The like if you own your house, so like your house, you're not taking depreciation expense, but you're also not going to have to. So you don't get the deduction now, but you also don't have a lower value of your house when you have to sell it. Your basis in the house is the same as what you paid. Now, if you were to move and you were to start renting out your house, the day you start renting is the day that you start taking depreciation expense on your taxes for that house, and that reduces the value that you get to claim for purchase on that.
Oh, okay, fair enough. I
So
think, but I
most
think
rentals,
Jeff's saying that he's got 18 units here, and I think that's exactly the type of person that I'm talking about that needs the protection. Somebody who's not going to be able to compete with someone who has 10,000 or a corporation that has 10,000 units. And we need to be looking at legislation, not as
well,
bubblegum and
so
duct tape
here's the problem
legislation.
though, is like if you say that like an entity can't own more than, let's say, 50 properties. I'm just picking a number.
Okay.
So if I'm BlackRock and I own 10,000 properties and the new law comes out and says I can't own more than 50, as BlackRock, am I selling off 9,900 units? No. What I'm doing is I'm creating 200 LLCs that are all subsidiaries of my main company, and each one of those LLCs owns 50 properties each. So
That's right. So look, I want to have another 5 or so minutes of this conversation. We will end our live stream at roughly 1 hour in roughly 2 minutes. So I want to thank you guys for joining us live. Stay tuned if you're on Facebook, YouTube, Twitter, Twitch, or TikTok. Those of you watching us live on Instagram, make sure you subscribe and feel free to transfer over to any other platforms. We'll be taking a quick and abrupt break in about 2 minutes, but let the conversation continue until we hit that music cue. So what you're saying, James, is exactly right, is that a company that has 10,000 units is just going to segment down to 10,000 divided by 50 or whatever that multiple is, that
mhm.
the cap of the units. And what I'm saying is that maybe it shouldn't be on a per unit basis, but it should be on an overall income basis. And
You're going to have the same
I
problem with
think you would
just a
have,
different
well,
divisor.
I think you would have that same problem also, but at some point the conglomerate, the umbrella organization that's owned by stockholders, right? This is a publicly traded company, BlackRock.
Yes, but not all the companies that are doing this crap are publicly traded.
I know, which throws another wrench in my thinking, and that's why it can't just be, we're gonna, what was the statement? The statement said, if we can make any difference, that's what matters. But but
Well,
the
the
goal should
problem
be
is
to
how do
stop.
you
But
combat this?
here's,
Because
well, hold on. Here's my issue though. Is just that the the goal needs to be the goal needs to be unattainable, right? The goal isn't to solve the problem. The goal is to make some changes. No, the goal is to solve the problem. What we're going to start with is as many changes as we can conceive. And what we're having a conversation right now isn't like one or two minor things. We're trying to have a conversation about a couple of bigger ideas, and I think we need to have real estate investors and people who own property, as well as having individual owners of property and having some bigger owners of property. That's our music cue. So let me pause. We'll say adios on the Instagram people. Thank you, Instagram, for joining us. Catch you guys next time. All right, we are out of Instagram. Everybody who's still watching, thank you for joining us. Hey, ladies on TikTok, nice to see you. Jeff, I'm hoping you're still here for the conversation. So my question to everyone then is, what do we do? What is a good solution? Is it a tax solution? Is it a
well,
banning
I think the
corporate
property
entities from
tax
buying?
solution is one.
But the property tax solution hurts the smallest owners the most. Just like the smallest owners are the ones that are in really bad shape right now because of the eviction moratorium.
Yeah, so I
Like
think what
Jeff
you
saying he's got eight. Sorry to interrupt you. Jeff saying he's got 18 units. What happens if he's got 4 people that just stop paying rent for 2 years? There's all of his profits and then some.
well, yeah, no, I get that, but it's to like, you know what? Like if you're in a position where you've got a home where people haven't paid rent for 2 years or something, like that might be a house that you might need to sell and let somebody else deal with it. And like,
Well, that's what you're going to have to do. That's what you
yeah,
have to do. But of course you're not going to get
but
the real value of the house because you have tenants who aren't paying rent. So that
yeah, and that's
hurt.
going to really hamper your ability to sell the house for anything close to what it's worth because they're inheriting a liability in the fact that somebody's still living there.
Yeah.
So I still come back to you need to limit the ability of corporations to be owning these single family houses. I don't have an issue with corporations owning like these big multi-unit or apartment complexes or something like that because that's a different market segment and that's but you
The
need to
issue is single family. The differentiation here, and the thing that has bothered you the most is the single family, and that's you see a lot more of that single family home ownership. Because I work in New York City, there's a lot more of the people who own multiple properties, uh, but but therein lies the conundrum is where do you draw these lines? Single family, I think if we're drawing any lines, that would be a really good place to start.
But so, all right, we can agree that like limiting the ability of corporations to buy single family homes for rental purposes is good, but I don't know how you go about doing it. Because as we said, like if you say you can't own more than 10 or 50 or whatever, then any firm that has half a brain is just going to like split off
Create a new
X number of
segment.
subsidiaries to find like it's an easily exploitable loophole, and I don't know how you close that. Um, Hold on, I'm
Yeah.
seeing something here. Solution is to classify basic human needs as basic human needs, and on entity, such profits are taxed at 100%, and that would include the sale of the house when you drop the property. So,
Well, why would we tax anything at 100%?
yeah,
Where are
but
you reading this? Or that's a private comment you have?
like, yeah,
That
Kevin.
sounds like
Kevin
a
sent me a
private comment
text.
from someone.
Yeah,
I'll finish the sentence, but from someone very liberal. So
yeah. Well,
taxing anything
so
at 100%
yeah, you can't. I don't think
is
you
not
can
going to
tax it
fly.
100%, but like the problem with an income tax based solution is the depreciation. Like that's written into federal law. That's just how income tax at the federal level works. Is if you have a business property, it will be depreciated based on its classification. A single family home is going to depreciate over 27 and a half years. So if you've got a mortgage that's costing like you let's say the house cost you $275,000. That's $10,000 a year in depreciation expense. If that mortgage is costing you $1,500 a month, and then you've got some nominal amount of repairs, let's say $5,000 worth of repairs a year, which is a pretty reasonable figure on a house that expensive. So you take 5,000 plus 1,500, all right, 1,500 times 12 is 18,000. So 18,000 plus 5,000 plus 10,000. You've got $33,000 of expenses. So as long as the rental, if you're charging less than $2,750 per month on that house, then you're showing a loss and you have no taxable income.
Yeah. Well,
There's no income tax on that because you're showing a loss on it. So yeah, you've got the property tax that you're paying to the local, but we already said that you can't. We're not going to jack up the property tax rates on these rentals any more than it already is. So you can't tax rental income on that. And the problem is there's another thing in federal law called a like-kind exchange, where if you sell a property,
so people are going to hold properties for 27 years and then exchange it for something comparable 27 years later.
yeah, and then they can defer the tax on that, where like that $270,000 gain that they would have shown or more, they can roll that into the next property and kind of shunt off the tax liability for another 27 and a half years.
Well, are they just kicking it down, or are they replacing that liability because they're making?
They're not replacing the liability, because if, let's say I bought the house for 270 and now it's worth zero after 27 and a half years according to tax, and I buy a $500,000 property and I do a like-kind exchange, that $500,000 property comes to me. I don't pay any income tax. I don't pay any income tax on the gain that I had on the sale of the property.
The 270.
But now my new basis in the $500,000 house is 230. So that depreciation basically just carries forward into the next property.
Well, so what if you bought a new place for for whatever amount that was? What was the original amount?
270,
Okay.
275. So I bought the place for 275, and let's just, for the absolute simplest case, I sold it for 275.
Yeah. Okay. And then you bought another place at 275.
Now my basis in that new place is zero.
Okay. So then what happens 27 years from now?
Same thing.
Well, no, let's say you don't do a like-kind exchange. What does your tax bill look like?
You sell it for 275, you're going to be paying capital gains tax on 275,000.
Oh, but not on 550,000.
Well, if you bought it for 550,000, then
No, but you bought it for 275. It's just you depreciated, did a like-kind, paid no tax.
Mm-hmm.
You didn't kick the tax bill down the.
Yeah, you did.
Not your 270. You just started over. You hit a reset button.
No, you didn't. If you
but
bought
you-
the place for 550, so I buy place one for 275.
Yeah.
Over 27 and a half years, it goes down to zero, and I took
Okay.
the expense every single year.
And you sell it for 275.
I sell it for
now,
275.
So now, in this moment, you owe tax on 275. But 2 weeks later, you buy another place 275. Now.
So that new place is also worth. If I do the like-kind exchange and it's structured properly, then the new place that I bought for 275 has a tax basis of zero. I don't have any taxable gain on the place I just sold, and the place I just bought is worth zero as far as tax goes.
Okay. So 27 years later, you sell it for 275 again. You're paying tax on 275.
Yes.
But you're not paying tax on 550.
No.
Okay. So that sounds wonderful. So I
right, especially when you consider that real estate tends to appreciate. If I buy a place for 275 now, 27 and a half years later, I like-kind out of it. Like I can take the 275,000 and roll that into the next property. So I bought the next property for $1 million. So now that property has a basis of like 725.
Mm-hmm. Yeah, but you just made a bunch of money actually. 27 years from now.
I'd still have to pay gain on like the amount above the 275. So I sold it for like 300. Then I'd still have to pay the gain on that 25,000, and that 275 gets rolled into the next.
Yeah. So look,
like income tax wise, it's tough to do that, because as long as you're charging rents that are like just marginally above your mortgage and repairs servicing costs, then you're going to be showing a loss on this, and there's no income taxable.
Yeah.
So that doesn't disincentivize these people.
So I don't think tonight we are going to come up with a decent solution in any way, shape, or form. I think it's something worth thinking about, but I think at this point, it's it's very similar to saying how are we going to build a colony on Mars and move there in the next 10 years.
Well,
It's like not it's that
I
it's
think the solution is that we need to get corporations out of owning and renting single family homes. How do we do it?
but see, your focus is on single family. Mine is more encompassing. Mine is also on the multifamily market because it's hurting people like Jeff and other smaller investors. So I think it needs to
But
be on
I'm
both
not
sides of
concerned
it.
about the people that are trying to invest. Like, if you want to be a real estate investor, good on you. But I don't think that those are the people that need the help. The people that need the help are the people that are 26 or 27 years old that have decent income and can't afford to buy a house. Those are the people that I care about.
Yeah, I mean, I think they should get some priority,
If
but
you
also,
have the money to be able to buy an investment property, you aren't the problem needing a solution.
I have seen prior to this last 2 years, with the legislation and then the eviction moratorium, small time investors be hurt a lot more than in a lot more numbers than people who are simply looking to buy their first home. So
I think that the problem is, like, if you're looking to buy investment properties and that's how you like to me that's a luxury to be able to do, whereas these people that are just trying to buy a home are trying to fill a need. So I don't think that comparing the two is even remotely reasonable, because one of these is I want to just make some supplemental income by investing in real estate versus I would like to own a home that will grow value for me.
but I think we're talking about a very similar issue. All right. So if you got a soccer field where a bunch of people are spraining their ankles, and you're saying you're worried more about offense and midfield, and I'm saying, yeah, but why don't we look at the whole field? And maybe it's an issue with the actual terrain. Like we should be fixing the terrain for everybody, not just offense and midfield, because they're all playing the game. The issue is that the people that own the field basically are winning all, and these big time investors is, and Jeff's saying this is a full time job. It's a luxury in the sense, and his question is, this is my full time job. How is that a luxury? And the issue is that he's working at this full time. To somebody who doesn't have any property at all, they look at you and say, you have so much more than me. You're in a more luxurious position because you have more. And that's why these two people, the small investor and the first time home buyer, can't get on the same page, because they don't see. And I'm not saying that Jeff's saying this, or the small time investor, or the first time buyer is saying this, but I can tell you they don't realize they're fighting the same battle. And the first time home buyer looks at a small investor like Jeff the same way they look at a BlackRock, and that's not a means to a solution. There's a lot more first time home buyers and small investors than there are companies like BlackRock, and unfortunately, also for the first-time home buyers, they're going to need people who have more money than they do, like the small-time investors, to pool resources and say, "Hey, it's not fair for us guys that work full time to support housing and take care of renters. We're all being fucked by the big-time conglomerate corporations buying all the property, and
Yeah.
that free market capitalism is not something that's going to be sustainable in the United States. We
So
need a different approach."
let me say why a first time home buyer would look at somebody like Jeff, who I understand that your full time job is managing your rentals. But to put myself in the shoes of a first time home buyer that can't afford to buy a home, I would now I'm going to make an assumption here that Jeff owns these properties, or he owns the company that owns these properties. So if I look at myself as a first-time home buyer, I say, you own 18 properties. If they stop making income, you've got these millions of dollars worth of properties that you can sell and have money. Whereas, like, I can't, yeah, so 12 LLCs. Right. So, like, But if they're owned fully by you, then like when you sell that, you get to keep the profits
What you're
or even
saying is
just
he has,
the assets.
if
So like
shit
if
goes bad for him, he has something to fall back on. Whereas somebody who's renting and trying to buy but can't, if they can't afford their rent, they don't have anything to fall back on.
yeah, it's
The
like it.
issue, but the issue here is, and this is the big issue, is somebody looks at somebody who has more and says, I want to take from them. And or they have more than I do, so I deserve to have more. That's not the issue. What I'm saying is we level the playing field, but we don't take from the smaller people. It, you,
I would agree with that, and I think, and like I know that I'm kind of dishing on in real
well,
estate investors and rentals, but I want to say that like rentals serve an important role in the market, and it's
but
important that there are rental properties out there available for people because not everybody wants to buy. You might want to just live in a city for 2 or 3 years before you move, and buying doesn't make sense, but renting does. So it's an important role that they're serving. And I would agree with you that yeah, the small time investors need help in similar ways that first time home buyers do. But first time home buyers are going to look at somebody that has 18 properties worth a couple $1 million and say, if something goes wrong, you've got a couple $1 million effectively in the bank, and I don't.
maybe, or more liability. It may not be all the buildings may not all be paid off. The issue is that taking either side of this is detrimental to the total solution. So you can take the liberal side of this, or you can take the conservative side, free market. Neither one gets to a solution where anybody wins. And if you have basically the liberal solution is we turn it all into public housing. That's
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 the
the
extreme case. I
that's
don't
but
think
that's
that.
but if you're leaning that way, guess what? That's the scales tend to tip the way that things are leaning. So that's where we end up because you end up electing officials that end up being super liberal, and they care about the super liberal. If we go free market, and then we end up in this monopoly solution where
Yeah, where
you have one
BlackRock
big
owns
winner.
everything and everybody's renting from BlackRock.
So the solution needs to be more down the middle line, but it can't be, well, if we do something, that's the best we can do. So we need to focus on doing something. That's 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 where you have solutions that don't make sense. And that's why we have so much disruption and discontentment with the coronavirus pandemic, because you have people making dumbass laws that don't make fucking any sense whatsoever. And because you have two sides that don't agree on anything, trying
Well,
not to
yeah,
strike agreements.
you had
So
some dumb laws that went too far one way, and then you had some dumb laws that went too far the other way in terms of like mandating masks in places where they probably weren't needed, or some states mandating that masks weren't allowed to be worn,
yeah, well, not that they weren't
or
allowed.
like preventing places from being able to institute reasonable mask mandates.
It just doesn't make sense. So the issue is that when you have two sides that can't see the common ground, then everybody loses.
So
So
let's establish what the common ground is here.
well, we got to wrap, and I don't let's I'll give it a shot, but I don't know necessarily we're going to come to a final solution here. I think
We
the
Jews don't
common
like the
ground,
final solution.
the, the final solution needs to be that property values can't be taking off the way that they are now, and the reason they're taking off is because of these conglomerate companies. So something needs to be done about them. Would you agree with me there?
Yeah, I would agree and say that like this the appreciation in real estate right now is unsustainable in our longer term goals because it's going to make it so that large portions of the population can't afford to buy a house, and because like, home ownership is one of the main ways that people build wealth by owning something that they can kind of just have.
I
And
I will agree with you there, and that's one of the biggest racial disparities in the
yeah,
country.
and so like the large amount of corporate cash that has flooded the market, and like by these firms specifically targeting like down market, and well, not down market but like middle market or like slightly below middle market homes that are exactly the kinds of places that a first time buyer would want to buy. That's the problem. Um, and it's not small investors that are doing it so much. It's really the big players like BlackRock. And so how do you curtail that? I don't know. And Jeff says, in my area, the individual sellers are asking way more than what they should. In this area, the large companies are eating up all the renters. So I
Well,
think
that
sellers asking more than they should, like that's a market solution. Where like if you're asking more than what you should, then you just won't get offers.
the issue is the buying power of the mega corporation. I think that a seller should ask as much as they. I, I I I mean, again, this is where you strike that fair market. This fair market line. What's fair market? Because you would think that it's a seller's duty to ask as much as possible, um, but then you have buyers that nobody can compete with that are paying these prices. What you're saying is that sellers will ask so much, but then the buyers have to pay it. But the problem is that buyers are paying it, and these buyers are big companies.
I agree.
So that is and where do you draw that line between what's a small company and a big company? It's really
Well, and even once you draw that line, how do you enforce it without having easily exploitable loopholes
yeah, like a big company just segmenting into smaller companies.
that all feed to one company in the end, but
That's, that was
legally
my
speaking, they're separate companies?
that was my umbrella analogy
Oh,
with stockholders. But no, yeah,
yeah.
you're repeating it. I'm agreeing with you. Look, we're not going to solve this tonight. I think we need to think on it. Anybody who has some thoughts and feelings on this, make sure you subscribe to this podcast on YouTube, where you can leave comments below. I would love to hear your comments about this episode 182.
We got to thank
This is
Jeff for all his good input.
Yeah, I think Jeff is a really good person to bridge the gap as a smaller investor with 18 properties.
Maybe ask him if he can come on sometime.
I think Jeff would be a really good person. I think I tried to put Jeff in touch with my friend Jamie, who's joined us before, the real estate attorney.
Hmm.
I don't know if they're in touch, but they both kind of speak from the same perspective. So Jeff, maybe we'll bring you on if you're open to that. But again, make sure you guys subscribe on YouTube, any of the audio podcast platforms. We love your input, and I love this topic because we haven't solved it in an hour and a half.
Not even close.
Yeah, no, we're still kind of circling around an angle to approach solving it. So, but I want to thank you guys for your time. James, thank you for being here. A big thanks to Rosh Galeb in the background, feeding us your comments live. Thank you, Rosh. Everyone, thank you for coming. On that note, adios.
Cheers.
All right, that concludes this episode. Let me know what you think. Let me know if you agree, disagree, what we missed, what we left out. And again, just your general philosophy on life. And I'll see you next time.
I like PBR. I just got priced out of it.